Let me welcome you to the Canada Revenue Agency's webinar on gifting and receipting. Thank you for taking the time to join us today. My name is Dylan, and I'll be your host for today's talk. The purpose of today's presentation is to provide charities information and resources on receiving gifts and issuing receipts. The presentation is split into two parts. For part one on gifts, we're going to cover what qualifies as a gift and the different types of gifts. For part two on receipts, we're going to cover what to consider when determining the amount of the gift, when they can be issued, and what information must be included on an official donation receipt. Before we wrap up, we'll also touch quickly on the extension of the deadline for making 2024 charitable donations and what it means for charities. This brings us to part one of the presentation. Let's start by explaining what exactly a gift is. A gift is a voluntary transfer of property without valuable consideration to the donor. However, a transfer of property for which a donor receives an advantage will still be considered a gift for purposes of the Income Tax Act, as long as we are satisfied that the transfer of property was made with the intention to make a gift. The existence of an advantage will not necessarily disqualify the transfer from being a gift if the amount of the advantage does not exceed 80% of the fair market value of the transferred property. And if you're feeling confused, don't worry. I'm going to break down each element of a gift and explain it in easy to understand concepts. Let's first look at exactly what constitutes property when it comes to defining a gift. Property can be broken down into two categories, cash and non-cash. So cash gifts include debit, check, and credit card payments. Non-cash gifts are other tangible gifts that can include capital properties such as equipment, lands, buildings, and stocks, personal property such as artwork, furniture, and clothing, life insurance policies, ecologically sensitive land, and gifts of Canadian cultural property. It's important to take a moment here to note that a charity is not required to accept every donation that is offered. You can turn down a gift if you have reached the cap on a project, or if the type of gift offered causes a financial burden to your organization. So for example, a food bank could decline a piece of artwork offered as a gift, as it does not directly relate to the work being done. Another example could be a library that has limited space. It could refuse a donation of books since it has no space for them. Whichever the reason, the charity has the final decision on whether or not to accept a donation. To figure out if a gift has been made, ask yourself the following questions. Was the gift made voluntarily? If the gift was made involuntarily, if we're talking about an obligation like a court order, then it is not eligible for a receipt. Was there a transfer of property? Did your charity actually receive property of any type? Gifts of service or promises do not qualify as transfers of property, and we'll cover this later. Was the gift directed to a specific person, family, or non-qualified donee? A donation that specifies that the gift is to be used in a particular program operated by the charity is acceptable. So for example, a hospital purchasing $1 million piece of equipment, but the donor can't specify an individual beneficiary. Did the donor receive an advantage? And if a donor receives an advantage in exchange for a donation, then part of the donation may not be included in the receipt, and we'll also cover this later. It's important to review all of these questions prior to accepting a donation. In this way, you can confirm if the donation is a gift or not. One of the most common questions we receive from charities is whether or not gifts of service qualify for donation receipts. Let's start by discussing what constitutes a gift of service. Simply put, a gift of service is when an individual or a business gifts time, skills, and effort for things like cleaning, roof repairs, catering, etc. Gifts of service do not qualify as property, as we discussed in the previous slide, and as such, you cannot issue an official donation receipt for these services. However, It may be possible to issue an official receipt in some limited circumstances, either by limiting the receipt strictly for the property, where a gift involves property and services, or by structuring the donation of services into two separate transactions. Let's illustrate this with an example. Here, it is important to note that this scenario doesn't account for taxes that Joe's Carpentry Company is required to collect and submit. So let's say you operate a food bank and need to build wooden shelves to store bulk items, and Joe's Carpentry Company offers to build them as a donation to your charity. The total cost is $200 in building materials and $300 in labor, plus applicable taxes. So in this example, you cannot issue a donation receipt for the $500 gift of services. However, you can offer a receipt in the following two ways. You can issue a donation receipt for $200, which covers the fair market value of the building materials. These building materials constitute a transfer of a non-cash gift. Or there can also be an exchange of checks, which means that Joe's Carpentry completes the new shelving for the food bank and issues an invoice to the charity for the full $500. The charity then pays the invoice, and Joe's Carpentry then voluntarily returns the payment to the charity as a gift, making the transfer a cash gift. The merchant must still collect and submit applicable taxes. A charity should never issue an official donation receipt to a service provider in exchange for an invoice marked paid. This alone does not establish that payments were exchanged. There needs to be an audit trail within your books and records to show that both transactions for the donation to be constituted as a gift. Now, let's talk about gift certificates or gift cards. It is quite common for a charity to receive a donation of a gift card. First, if the gift card was donated directly by a store, then it is not considered property, but more like a promise. So the charity won't be able to issue a receipt until the gift card is actually redeemed, meaning it was used to buy something. However, if the gift card was gifted by a person who bought it, then the charity can issue a receipt for the eligible amount of the gift. If you found that confusing, let me explain it a little bit more. The reason why a donation receipt can be issued for a gift card that was donated by a person who purchased it, as opposed to a store that just issues it, is because of the consideration paid for by the person is what becomes the property that is the subject of the gift. However, if the gift card was donated by a store, then it's nothing more than a promise to make goods or services available to the certificate holder. No one paid for the gift card, and therefore it isn't considered property. Hopefully that made things a little bit clearer. Directed donations. Basically, when people donate to a charity, they can request their donation be used for a certain program, but cannot request that their gift be directed to a specific beneficiary. Here are a few examples. If Joanne donates to a hospital, she can request that her donation be spent on medical equipment. Bill can donate to a disaster relief program and ask that his donation go to fire victim relief, but can't ask that it be used for his friend Josh, whose house was destroyed in a fire. Having said that, a charity can also reallocate donations within their programs as they see fit. It's important to note that the charity has the final say over how donations are used, because if donors retain control, then the donations are no longer considered gifts at law and a receipt cannot be issued. We suggest that your charity clearly state on its website or fundraising material where it will be reallocating donations once the target is reached for a certain program, or if it cannot be reached. This will help donors decide whether or not they want to proceed with their donation. Now, you might be wondering whether a donor can request to have their donation returned to them. Once gifted, your charity cannot return a donation to a donor. Why is this? And it's because a charity can only use its assets to further its charitable purpose. Returning a gift it has taken ownership of would be like gifting to a non-qualified donee. Occasionally, a charity may be presented with a court order requiring it to return a gift. In such a situation, it may be legally obligated to do so, but should get legal advice in deciding how to respond. Other than this, a charity should never return a completed gift to a donor. This brings us to part 2 of the presentation. Let's talk about receipts. Only registered charities or other qualified donees may issue official donation receipts. For donors, these are required to claim a tax credit. No receipt, no credit. It's as simple as that. Under the Income Tax Act, qualified donees are organizations that can issue official donation receipts for gifts they receive from individuals and corporations. This graphic shows exactly what types of organizations are considered qualified donees. The largest category is registered charities, but there are additional categories that also form part of the qualified donee status. Registered Canadian Amateur Athletic Associations, registered National Arts Service Organizations, registered journalism organizations, municipalities, municipal or public bodies performing a function of government in Canada, registered universities outside of Canada, low-cost housing corporations for the aged, His Majesty and Right of Canada, a province or a territory, and the United Nations and its agencies, and registered foreign charities that have received a gift from His Majesty and Right of Canada. You can find a listing of all qualified donees at canada.ca/charities-giving. This listing includes all registered charities T3010 information. Let's now move on to the next topic, the amount of an advantage. Basically, before you can issue a gift, you need to determine whether a charity provided any kind of consideration for the gift, whether it's to the donor or even another person. So, what is an advantage? The amount of advantage is essentially the total fair market value at the time the gift is made of all property, services, compensation, or other consideration made or payable in relation to the gift. We'll go through some more specific examples over the course of the next few slides. Some examples of an advantage may include dinner at a fundraising event, performance at a fundraising event, door prizes at a fundraising event, and use of property. If there is an amount of advantage, then part or all of the donation may no longer qualify for a receipt. When there is no amount of advantage, a receipt may be issued for the full amount. Keep in mind that you may need to consider any future advantages in this consideration. So for example, if an individual donates $50 to your charity and will in return receive 20% off the price of their admission to your next fundraising gala. Here's where it gets interesting. Let's take a look at this example to better understand how receiving an advantage works. So if Joey made a donation and received a promotional item like a water bottle, and then the split receipting method would be used to calculate the correct amount to put on the receipt. For example, if Joey donated $10 and received a water bottle valued at $2, then Joey would be issued a receipt for $8. And this formula is true most of the time, but not if the amount of the advantage is over the nominal threshold or the amount of the advantage is more than 80%. We'll cover this in detail later in the presentation. On the previous slide, I mentioned fair market value, which is the highest price in dollars that a property or item would bring in an open and unrestricted market between a willing buyer and a willing seller who are both knowledgeable, informed, prudent, and who are acting independently of each other. Keep in mind that if the fair market value cannot be determined, then the charity cannot issue an official donation receipt. So, how do you determine the fair market value of a gift in kind? Basically, if the value of the property is under $1,000, then a person with sufficient knowledge can determine the fair market value. Usually, the person who bought the property could determine the value by showing the receipt, but keep in mind that taxes like the GST, HST, and TVQ are not part of the fair market value. So, for example, if your charity receives a TV as a donation and one of your volunteers sells TVs at a local store, they would be able to determine the fair market value. Under the deemed fair market value rule, the value of the property transferred will either be the lesser of the fair market value of the property and its adjusted cost base. And we call this the lesser of rule. Having said this, there are exceptions to this rule, and in these cases, the value of the gift is the fair market value. So gifts made as a result of a taxpayer's death, gifts of property, gifts of real property located in Canada, gifts of publicly traded securities, gifts of certified cultural property, and ecological property if the recipient charity is not a private foundation. The deemed fair market value rule applies to gifts if one of the following situations applies. The donor acquired the gift less than 3 years before donating it. The donor initially acquired the gift as part of a tax shelter arrangement, or if the donor acquired the gift less than 10 years before donating it, if one of the main purposes being to gift the property to a qualified donee, so for example, a registered charity. It's very possible that you will encounter a tricky situation where you aren't sure how to assess the value of a gift. Hopefully, this example will help you better understand how the deemed fair market value works. Let's say that somebody bought a painting for $250 and donated it to your registered charity 6 months later. Suppose that during those 6 months, the painting gained value and is now worth $1,000. In this situation, would we apply the fair market value or the deemed fair market value? If you guessed deemed fair market value, you're right. If we look at the deemed fair market value rule condition, since the gift was acquired less than 3 years ago, we would apply the deemed fair market value, which is $250. This brings us to the intention to give threshold. In other words, did the charity have the intention to give when they made their donation? If the value of the advantage is more than 80% of the donation, then we say that there was no intention to make a gift and the charity should not issue a receipt. For example, if Carly donates $100 to a charity and receives a dinner package worth $90, then a receipt cannot be issued, and that's because the advantage is more than 80% of the donation. On the other hand, if Jim donates $150 to a charity and receives the same dinner package worth $90, then a receipt can be issued. And as you can tell, the advantage is less than 80% of the donation. In some cases, the advantages are considered too small to affect the value of the gift, and this is called the nominal threshold. The nominal threshold means the advantage does not need to be deducted from the value of the gift if the fair market value of the item is less than the lesser of $75 or 10% of the gift. Keep in mind that this rule does not apply to cash or near cash equivalents and core elements of a fundraising event. As an example, for a dinner event, the dinner cannot be considered under the nominal threshold as it is the core element of the fundraising event. Let's take a look at an example where you would use the nominal threshold to better understand it. Suppose that somebody donates $200 to a charity and they receive a t-shirt worth $15 in return. Because the t-shirt is less than 10% of the $200 donation, the charity would have to issue a receipt for the full $200. Now, let's say that somebody donates $50 to a charity and receives a keychain worth $10 in return. Because the keychain is more than 10% of the $50 donation, the charity must use the split receipting rule and issue a receipt for $40. Finally, let's say that somebody donates $2,000 to a charity and receives a wine bottle worth $100 in return. Even though the wine bottle is less than 10% of that $2,000 donation, the charity would still have to use the split receipting rule as the wine bottle is worth more than $75. In this case, the charity would have to issue a receipt for $1,900. Let's also go over a more complex example of how to calculate the advantage. Let's say that a charity is holding a fundraising event with a reception and a concert. The tickets are $200 each, and the charity is selling 500 of them. The kinds of amenities provided by the charity for purchasing a ticket worth $200 are the following: a concert with a fair market value of $80, food at the reception with a fair market value of $20 per person, gift bags with a fair market value of $17, door prizes with a total fair market value of $1,000 or $2 per ticket. There are raffle tickets that are sold separately, and there's a cash bar at the reception. The last items on the list, the raffle ticket and the cash bar, are not considered advantages, and this is because the raffle tickets are sold separately from the event and because the guests at the event are purchasing their own drinks at the cash bar. Let's start with the gift bags and door prizes. Yes, they are considered advantages as they are included in the ticket price. However, in this case, we need to consider the nominal threshold, which, remember, we said means an advantage doesn't need to be deducted from the total value if it is not a cash or near cash equivalent or a core element of the fundraising event, and it is less than the lower of $75 or 10% of the overall $200 ticket price. And this is because 10% of $200 is $20, and the gift bag, which is worth 17 plus the $2 door prize, is less than $20. Therefore, it's not considered an advantage. Next are the concert and food at the reception, which are worth $80 and $20 respectively. They are core elements of the event. Both the concert and dinner are considered advantages worth $100 in total, so this amount must be used to calculate the amount of the receipt. Let's go over the events calculation then. We've already determined that the advantages at this event are the concert, $80, and the reception, $20. At this point, you might be tempted to issue a receipt for $100, and this would be after calculating that $200, the cost of the ticket, minus the advantages worth 100, equals $100. However, you need to be careful. We need to take into consideration the intention to give threshold, which states that if the advantage is above 80% of the donation, there was no intention to make a gift. In our example, however, the advantage is below 80%, and therefore the donor is considered to have made a gift, and the charity can issue a receipt for the eligible amount of $100. Another area where charities frequently need to decide whether or not they want to issue donation receipts is at an auction event. Generally, there are two opportunities to issue donation receipts at a charity auction event. First, a charity can issue a receipt when somebody donates a property to be auctioned. And second, you can issue a receipt when an item is purchased during an auction. Remember, a charity is not obligated to issue donation receipts in this type of situation. It's quite common for charities to not issue donation receipts. What's important is to state at the beginning of your auction or event within your marketing ads and posters. If you choose to issue receipts, there are factors you will need to consider. If somebody donates property to be auctioned, then the charity can issue a receipt at the fair market value or deemed fair market value. You should remember that gifts of service and gift cards from a store are not considered gifts like we've discussed earlier in our presentation. Also, if the fair market value cannot be determined, then the charity cannot issue a receipt. If somebody purchases an item during the auction, successful bids must satisfy the intention to give threshold, which is the 80% rule. The fair market value of each item should also be displayed during the auction. Consider this example. Let's say that a painting with a fair market value of $1,000 is auctioned and that somebody bid $1,300 for it and won. Before issuing a receipt for this item, the charity will have to take a few things into consideration. Did the bidder satisfy the intention to give threshold? In this case, the answer is yes, because $1,000 of 1,300 is 77%, which is below the 80% threshold, and therefore the charity can use the split receipting rule and issue a receipt for $300, which is the difference between the bid and the fair market value of the painting. Here's a little tip. If the item up for bid has a fair market value that can be determined, you could show bidders the amount they need to bid to receive a donation receipt. You simply take the fair market value of the item and multiply this by a factor of 1.25. Any amount over this bid will indicate that a donation receipt can be issued. With our example here, the fair market value of the painting is $1,000. If you multiply this by 1.25, the bidder would need to place a bid of over $1,250 to receive a donation receipt. There are also transactions generally not eligible for receipts for income tax purposes. We've already seen a few of them, but there are many more. So for example, basic fees for admission to an event or program, payment for a lottery ticket or other chance to win a prize, purchase of goods or services from a charity, loans of property, use of a timeshare or lease of premises, gifts of service, gifts of promises, donations in exchange for advertising or sponsorship, a gift in kind if the fair market value cannot be determined, payment of membership fees if there's an advantage or entitlement exceeding the 80% threshold, and a donation for which the fair market value of the advantage or consideration provided exceeds 80% of the value of the donation. We've spent a long time talking about what you can and cannot issue a donation receipt for. Let's now look at the kind of information that must be included on an official donation receipt. This is only one example of the 4 types of receipts available on our website at canada.ca/charities-giving. We'll post the link in the Q&A for your reference. The authorized signature on the donation receipt can be anyone that the charity designates. We recommend that you limit the number of signatures, but it doesn't matter who the signer is. Here's a list of the information that must be included on an official donation receipt. A statement that it is an official donation receipt for income tax purposes, the charity's name and address, the charity's registration number, and please note that other qualified donees do not necessarily have a registration number, so they do not need to include this. The serial number of the receipt, the location where the receipt was issued, the date that the donation was issued, the donor's first and last name with middle initial, the donor's address, the amount of the gift, the value and description of the advantages received, the eligible amount of the gift, and signature of the individual authorized by the charity to acknowledge donations, and finally, the name and website of the Canada Revenue Agency. And for non-cash gifts, the following information should also be included. The date of when the gift was received, if not already known, the brief description of the gift, name and address of the appraiser if the property was appraised, and the amount of the gift is the fair market value, or if it applies the deemed fair market value. Before we go, we did want to take a moment to address the extension of the deadline for making 2024 charitable donations. As you may have heard, on December 30th of 2024, the federal government announced its intention to amend the Income Tax Act to extend the deadline for making charitable donations eligible for tax support in the 2024 tax year. Since then, the Department of Finance released draft legislation in support of this proposed change, which will be introduced into Parliament in due course. In summary, the proposed legislation offers donors the option to claim or deduct certain charitable donations made up to February 28, 2025 on their 2024 income tax return. Specifically, donations of cash or transferred by way of check, credit card, money order, or electronic payment. But what does this mean for charities? First, You should know that there is no requirement in the Income Tax Act for a registered charity or other qualified donee to issue an official donation receipt, or that it issue a receipt within a certain time frame. However, if your organization chooses to do so, it should continue to issue official donation receipts according to the receipting rules that we've covered in this presentation. Second, the extension will not affect how your charity reports tax receipted revenue on its 2024 and 2025 T3010 registered charity information return. All official donation receipts issued during your charity's 2025 fiscal period should be reported on its 2025 T3010 information return. Third, as you do for all donations, we encourage you to maintain detailed and organized records of your activities. While not mandatory, it is good practice to keep all postmarked envelopes of donations received by mail. You should consider documenting which receipts were issued during the extension period. These records can help you respond to inquiries from donors or the CRA. And lastly, remember that the receipting rules still apply for determining the date of donation. So for in-person donation or electronic transactions, the date of donation is the date the qualified donee receives the gift. And for donations sent by mail, we consider the date of the postmark on the envelope as the date of donation. The qualified donee should keep the stamped envelope as part of its books and records. And lastly, here's the number to reach our client service representatives dedicated to charities: 1-800-267-2384. There, you can speak directly to one of our representatives, and they're available to help you Monday through Friday from 8 a.m. until 5 p.m. Eastern Standard Time. Thank you so much for attending today's webinar. We hope we were able to answer your questions. We'll be sending you a link to an online survey about today's webinar, and please take a few minutes to complete the survey. Your feedback is really important to us. It helps us evaluate the effectiveness of our webinars and plan for our future outreach activities. If you would like to receive recent news and updates from the CRA, we recommend that you sign up for our electronic mailing list at canada.ca/charities-what's-new. And if you haven't already, make sure that you sign up for CRA's My Business account using the link provided. My Business account is a fast, secure, and easy way for you to access your CRA account information and file your annual return. Thank you.